Sure. The task force is one of 16 industry-specific task forces that have been assembled by the AICPA. And the real objective of these task forces is to do an industry-specific overview of the new revenue standard to identify issues that might be industry issues that need further attention from an industry perspective, issues that might, if not investigated on a group level, lead to inconsistency in implementation. So that's the objective, and the participants are really a broad array of members from the accounting firms that specialize in this industry, as well as companies that are operating in the industry, either unregulated or regulated, as well as leaders from industry trade groups like the Gas Association and the Edison Electric Institute. Well, I think the main reason really is that the new revenue standard is supposed to be industry agnostic, and so whereas in the past in the U.S. we've had a lot of very specific industry-oriented gap, today we don't have that anymore, at least when the new standard becomes effective. And so the AICPA realized that in order to achieve consistency across industries, it would be necessary to have these groups get together, identify issues, vet the accounting, and hopefully when implementation happens, we see consistency across the practice. The other thing that's been kind of in the background is the SEC has been quite vocal in letting folks know that when this standard is implemented, they don't expect to see outliers. And so when the regulator is being vocal about their expectations, the industry groups get together and try to make sure that they manage that risk. Good question. So the task force, again, consists of primarily industry people. And so we don't really have any folks, professionals in the auditing or accounting profession that are outside of the industry that are on the task force in particular. But the AICPA realized that in order to validate the work of these task forces, they would need to create kind of unbiased, independent review bodies. And so there are actually two review levels on top of the task force. One is called the Revenue Recognition Working Group, and that group consists of members from accounting firms, members from companies that are outside of the industry. They kind of take an unbiased look, also compare the work of the various industry groups to see if there are commonalities that should be addressed similarly. And then above them is a group comprised of FINREC representatives, FINREC being the body that speaks for AICPA on reporting and accounting matters. So there's really two layers of review above the task force that will ultimately look at our issues. Well, the idea is that at the end of this, we will produce a AICPA publication, something that is similar to an audit guide that you might see today from the AICPA. So this would be a book that somebody could go out and purchase from the AICPA or see online, and it would really memorialize the work of the task forces and memorialize the issues that were entertained at the conclusions reached. The tariff sale issue is an issue for regulated utilities, and it really relates to a scoping issue. The question is whether or not sales to a regulated customer under tariff rates are within the scope of the new standard, and whether the revenues from those arrangements should be presented as revenues from contracts with customers. The task force has reached a consensus that those particular contracts would be in scope, that tariff sales would be in scope, and therefore the revenues from those relationships would be presented as revenue from customers. One important thing to note is that the extent of the contract from a tariff sale is deemed to be just the utility's performance to date. So it's not like you'd have to go through and estimate an average customer life or do something else to come up with a contract term. The contract for accounting purposes would be deemed to be the performance completed to date, and therefore the utility's service they've provided and the receivable they've got from the customer at that point in time. Well, there were a couple things that were raising this question in some people's minds. First was when the FASB finalized the revenue standard, they did a specific carve-out or scope-out of something called alternative revenue programs, which some of the utilities, some of the regulated utilities have. And in doing that carve-out, they said that the reason they were separating alternative revenue programs was because they were a function of a contract between the utility and its regulator, not the utility and its customer. And since alternative revenue programs are typically a function of the tariff and recovered through the tariff, I think a lot of people looked at that and said, well, if alternative revenue programs are out of scope, then isn't it by extension logical to say that all tariff sales are out of scope? And so we had to address that. I think the other reason is a lot of times, sales to residential customers or some commercial customers don't really have a contract in place. And so this whole standard is about revenues from contracts with customers, Whereas in a utility setting, in a utility environment, in many cases you don't have a formal contract, particularly a long-term contract with many of your customers. You're selling under tariff rates, and that's the other reason the issue came up. Yeah, good question. So to start, a blend and extend transaction is really a form of a contract modification where a contract that exists with a customer is extended. So let's say a 5-year contract is extended to add 2 years to it. And in connection with that extension, the rate that you're charging your customer is actually blended. So the remaining rate from the original contract is blended with the new rate you would have charged the customer for that extension period, and you get a new rate starting at the modification date. So it's really a contract modification, and the issue really is in how to apply the new revenue standards contract modification rules. There were a couple of views that emerged on this one. One was that the extension period in a blend and extend is really a separate new contract, and you should just account for it and account for revenue from it using the appropriate price that would relate to that extension period. The other view is that the entire remaining contract now, so whatever was remaining on the original plus the extension, that whole period of time now represents a new contract with the customer, in which case you might get to a different revenue pattern because you might just recognize the new blended rate as your revenue over time. So this issue came up and was discussed by the task force. We could not reach a consensus, and so this issue was actually addressed by the FASB in the form of a technical inquiry, and they ended up saying that they would accept either approach. So in practice, I expect most people to adopt the new contract approach, which results in kind of a steady revenue recognition at the new rate. I think that's more consistent with practice today and probably an easier accounting model to follow. But that is something that the FASB would accept either approach on, and we'll probably see some of both in practice. So strip and step pricing are two different pricing conventions that we commonly see in commodity sale arrangements. A strip price just refers to a fixed price over the full contract term. And a step price, as the name suggests, refers to a price that elevates or ratchets up over the contract term. So in both cases, the prices are fixed. In one case, the price is constant over the full contract. In the other case, it ratchets up over time. Yeah, so the accounting issue really relates to the appropriate pattern of recognizing revenue for those two types of transactions. The strip price contracts and the step price contracts are priced differently, but they feature the same performance on the part of the seller. So the seller is selling the same volume of commodity units over the same time frame. So many participants in the industry would like to be able to recognize both of those contracts, recognize the revenue from those contracts according to the invoice price. And so the question becomes, is it possible under the standard to get to different revenue patterns for two contracts that feature the same performance on the part of the seller? So the task force has actually reached a consensus on this one, and we believe that it is possible to get to two different revenue profiles for these two contracts, despite the fact that they feature the same performance on the part of the seller. The way we get there is the strip arrangement, we believe, just goes through the model, applying its normal provisions. And when you apply the model to an electricity contract, an electricity forward, you typically apply the series guidance, what's something called the series guidance, and you measure your progress toward completion of that series. And you would do that using some sort of an output method, and you would get to recognition of a constant amount of revenue. So the revenue will just, by virtue of being recognized pro rata, mirror the invoice price. That's for a strip contract. On the step contract, on the other hand, we believe that in many cases, it will be possible to use a practical expedient that the standard provides for that's available when the value provided to the customer is reflective of the invoice price. And we think in many cases, step price arrangements will meet that condition. And so for step arrangements, we believe it'll often be the case that you could apply that expedient, which allows you to recognize the contract at its invoice price each delivery. So the end effect of that is that both contracts get recognized at their invoice price as delivered, which will differ, but we think that it's supportable under the contract. This one has been discussed at the task force level. We've reached a consensus. We've also discussed it with the Revenue Recognition Working Group, and they have agreed in principle with our approach. At this point, this one needs to be reviewed with the next review body, which is FINREC. So the issues with variable consideration really stem from a pretty significant difference between today's GAAP and the new standard. Today under GAAP, we do not recognize contingent revenue until it's realized. Under the new standard, you're actually required to estimate what your variable consideration under a contract will be and recognize that as you earn it over the contract term. There is a notion of a constraint that exists that will in some ways limit the amount of estimate of variable consideration. But in general, you're required to make the estimate. You're required to recognize it as earned, so that has the effect potentially of accelerating revenue under the new model as compared to today's practice. So the revenue constraint is really designed to make sure that folks don't recognize revenue early that they eventually will not realize through cash. And so if you think about it, the standard is don't recognize amounts unless it's probable that they will not be subject to a significant reversal in the future. So there's a few double negatives in there. It's kind of a confusing concept, but the idea really is be conservative in your estimates of variable consideration and don't bake them into the transaction price unless you're confident that you'll ultimately earn those dollars. So there are a couple main drivers of variability for us. One is price variability. So if you think about indexation or other forms of variability that could drive price differences in a revenue contract for a utility, performance bonuses being another example, a plant owner that can earn a bonus at the end of their contract term based on the performance of the plant. Another major driver is volume variability. So we think about requirements contracts or other contracts that have uncertain volumes over the contract tenor. Those also come into play. This is another area where we've developed a video that does a deeper dive into variable consideration. So there will be a chance for those that want to understand more about specific aspects of price and volume variability to go to that video to learn more. Yeah, so partial terminations really is an issue related to an agreement between a seller and a customer to terminate part of a contract that's already existing. So if you think about a 10-year forward contract for the delivery of a commodity such as electricity, it's not uncommon for the buyer to approach the seller during that term and say, I need to terminate a couple of the years on the back end of the contract. So let's say, for example, a 10-year contract, the customer wishes to terminate the last 3 years of the contract. They just simply don't need the commodity for those periods any longer. So one of the things that we see when that happens is the seller is often willing to terminate. However, they will require the customer to pay them a termination fee for doing so. And the termination fee is equal to the fair value of those canceled years. Exactly. That's the debate, is whether the consideration received from the customer for canceling those out years is something that can be recognized or should be recognized immediately. And so the task force has looked at this and has concluded that we believe that that consideration should be recognized by the utility immediately. It relates to contract years that will no longer happen. The consideration that was received related specifically to those periods, and so we believe that is consideration that should be recognized currently in the income statement. There's a bit of a debate about whether that should be revenue or just income, other income, for example. Since the utility will not serve those last 3 years in my example, many think that it's really more of a other income item than a revenue item. A good question. It's probably not isolated just to out years. There could also be situations where the volumes in a contract for its remaining term are cut. For example, a 5-year contract where the volumes are just cut by 20% for all of the remaining years. So it could be a horizontal slice, such as a volume slice. It could also be a vertical slice, such as years taken off the back end of a contract. I think either scenario would beg this question. So as I mentioned, the task force has reached a consensus on this issue that the consideration should be able to be recognized currently. We have not run this issue through the Revenue Recognition Working Group yet, and so that's our next step. So bundled sales are really just sale contracts that contain multiple discrete deliverables. Today in US GAAP we have the concept of multiple element arrangements. So this is really a similar concept. In the new standard, they're called performance obligations. Under existing GAAP, they're called elements. And so the issues here are really looking at the bundled contracts, trying to make sure we are clear on what the discrete elements within the contract are, and then also thinking about how we need to combine those elements, or if we need to combine those elements together to form performance obligations. And so that's really what this particular issue is all about, is identifying the relevant elements and then thinking about whether they should be combined. And in our industry, we have some real obvious examples of bundled arrangements, the most notable one being a PPA, power purchase arrangement, which often contains both capacity and electricity. We also have green power sales where the buyer receives electricity as well as the renewable energy credits, or RECs. Yeah, renewable energy credit is just an attribute, a renewable attribute that a renewable power plant receives from the government when they produce power from a renewable resource. So if you think about a wind farm or a solar farm, when they produce electricity, they get renewable energy credits as well. And it's very common for them to then turn around and sell those renewable energy credits to a customer along with the electricity. So our focus in this area has largely been on making sure we've identified the appropriate elements, making sure we've thought through when they should be combined or not, and also thinking through when the revenue from the delivery of these various elements would occur, whether or not they were combined. There's been a little bit of consternation and debate around whether certain ones should be combined in various circumstances. So some of our work is focused on, regardless of whether they were combined, when would the revenue from these elements be realized or recognized? And in many cases, we found that it would be at the same time. And so that takes some of the pressure off the analysis around whether to combine or not. So that's been a large part of our focus. And this issue is also one that we'll talk more about in a further video. We'll get into some of the discussion around the various elements and when they might transfer to a customer, therefore permitting revenue recognition. So CIAC stands for Contributions in Aid of Construction, and this is really a concept that's relevant for regulated utilities. Regulated utilities have to serve everybody in their service territory. That's part of their mandate, but they don't always have to serve everybody at the same cost. And of course, depending on where you are in the system, it may cost more for the utility to serve you. So in some cases, in order to get a new connection, the utility will require the customer to contribute to the cost of applying or extending the service. So that's referred to as contribution in aid of construction. So if, for example, if it costs the utility $100 to establish a connection to a customer in a remote location, but their feasibility model that says this is what I can invest in this and still make money through the customer relationship would only allow them to invest $80, they would require the customer to pay the difference, the $20. And so it's a very common feature for regulated utilities, particularly those that are making frequent service connections. And it's something that, lets the utility only invest what they will ultimately recover from their customer. So today, CIAC is accounted for on a net basis effectively. The utility receives the money from the customer and they reduce their investment in plant by a corresponding amount. So if the utility invested the 100 in my example in the extension and then they received 20, they would show a net plant balance of 80. It is not accounted for as revenue under today's practice. Well, it's uncertain at this point. This is an issue that's gotten quite a bit of attention by the task force, and we're currently working through it. The consensus of the task force is that practice should not change, but it's going to be perhaps a hard issue to get through these different review levels, because in other industries, to the extent that you have upfront costs that are reimbursed by your customer, those will tend to be recognized as revenue by the seller over some contract term that they establish with their customer. So at the task force level, we've discussed this issue quite a bit. We think that the regulatory mandate and the regulatory construct that a utility works under, coupled with the fact that there really isn't a customer contract in most of these situations, differentiate CIAC from those other examples of upfront costs being incurred by sellers. And so we are planning to suggest that the answer be no change from current practice. CIAC would not be recognized as revenue, and we need to vet that conclusion with the Revenue Recognition Working Group. That's our next step. Yeah, so SASP stands for Standalone Selling Price, and that's a concept that's used in the new revenue standard to establish the value attributable to the individual deliverables in an arrangement. And it's an important concept because the standalone selling price is used to dictate the amount of revenue recognized and therefore result in appropriate margins being recognized by sellers for the various goods and services that they deliver to a customer. One of the reasons it's important in the utility industry is because many contracts, as we've discussed earlier, are priced at kind of a strip or constant price. And so if something other than a fixed price was used as the standalone selling price for commodities, we might be in a situation where margins for some of these commodity sellers are significantly distorted. Well, the leading candidate for that question is the use of what's called a forward curve. And so in the commodity industries, it's very common for forward curves to exist, basically transparent pricing that show what the commodity is expected to trade for at various points in the future. And that is what many people believe is indicative of standalone selling price for commodities. And so if the forward curve were used, there could be situations where margins would be significantly distorted for these strip price contracts, particularly for sellers that have locked in their costs and therefore have a constant cost profile as well. Well, this one was quite controversial as well, and this one ended up going to the FASB staff again for a technical inquiry. One of the things that they noted in their discussions with us is that other industries don't really have forward curves, and it wasn't their intent that the utility or commodity industries in general would be held to a different or higher standard. So their view was that the forward curve would not have to be used for establishing standalone selling price for these commodity deliveries. There will often be other means available to determine that. And we're currently working through, with them a way to memorialize their view so that we can get that elevated and run that through the Revenue Recognition Working Group and the FinRec group as well. I guess there's always a chance, although our strong expectation is that they will accept the FASB staff's view. The FASB staff has got kind of a interesting role in all this. They really aren't one of the bodies that is supposed to weigh in on implementation. There's the TRG that's been established to do that. But in this case, TRG has not been taking many of the industry-specific issues. Instead, they've been asking the FASB staff to look at those and think about whether technical inquiries are appropriate. So my expectation is that when the FASB staff does a full-blown technical inquiry, which is a formal process, that it would be honored by these review groups. And so I think we're gonna get the answer. That answer will stick, and we'll just have to get it memorialized. Yeah, that's right, 3 to go, and actually one of these issues I expect to fall off of our list, and so I really think we'll just ultimately have to deal with 2 of these 3. The one that I expect to fall off the list is the one related to real estate sales. In thinking through the implementation concerns of the industry, one of the things that we identified early on was the fact that real estate sale accounting often affects utilities because of the fact that they sell plants and other large fixed assets. And so one of the things that we've done is thought about, since real estate rules are going away, industry-specific rules, how do we replace those? And we also realized that the notion of partial sales of real estate, so when you sell a 30% interest in a plant or something to that effect, those were not specifically addressed in the new standard. So that was kind of a black hole in the guidance. Now, since we've identified that issue, we've learned that the FASB actually is also aware that there's a black hole in the guidance, and they are working to address it through another active project. So my expectation is that that project, which is the asset versus business project that's currently on their agenda, will be resolved before the effective date of the new revenue standard, and therefore we won't have to address it ultimately in our work. So the other 2 are very recently added, so I don't have a lot to say about them, but I'll give you a little bit of an overview. The first one is a collectability issue, and this is an issue for regulated utilities, and it really just deals with sales to low-income customers. The new revenue standard has a collectability threshold. Collection has to be probable in order for you to conclude you have a contract with a customer. And so there's some questions around whether this threshold would be met for sales to low-income customers. So some of the considerations that the utility groups are going through include, what about mechanisms within our tariff structure that allow us to socialize credit losses from low-income customers? A lot of utilities can bill that credit loss back to the broader customer population. And another question is there a price concession embedded in these arrangements? If you're billing a full tariff to this customer but only expect to collect half, perhaps there's a price concession, and you would just view it that way instead of saying there's a collectability concern. The other issue relates to alternative revenue programs, and as I mentioned before, alternative revenue programs were specifically scoped out of this new revenue standard 606. And because of that, any revenues that are realized by utility related to these programs have to be presented outside of revenue from contracts with customers on the face of the income statement. So one of the questions that's arisen is, it's often the case that revenue from these programs is recognized before the amounts are actually built into the customer tariff and billed to customers. And so the question that arises is, I've already recognized this revenue in a line other than contract revenue from customers. And what happens maybe a year down the road when that amount hits the tariff and actually gets billed and collected from customers? Do I recognize customer revenue at that point and have to therefore take a reduction in my alternative revenue program line, or do I just do nothing because I've already recognized the revenue in the first place? So that's really the issue, and there are different views that are on the table for that one, and that's going to have to play out over the next month or so.